Welcome to today's lecture. Our topic is the international monetary system. Today, we'll look at how the world decides to manage exchange rates after World War II. We'll study the Bretton Woods system and why it later collapsed. We'll study the floating exchange rate system that replaced it. We'll also study the long-running debate between fixed and floating exchange rates. Finally, we'll look closely at China's exchange rate policy, since it's one of the most discussed cases in the world today. By the end of this lecture, you'll understand why exchange rates move the way they do and why governments still argue about the best way to manage them. Let's begin. As you listen, keep one central question in mind. Every exchange rate system, whether fixed or floating, is really just a different way of answering the same problem. How should the world balance economic stability against economic flexibility? So this is today's roadmap. We have 8 main topics. First, we'll study the Bretton Woods system. This system used the fixed exchange rates, and it was designed to bring discipline and flexibility at the same time. Second, we'll look at the pen. Okay, here we'll look at the the role of the World Bank. Third, we'll study how the fixed exchange rate system finally collapsed in the early 1970s. Fourth, we'll study the floating exchange rate regime that replaced it, formalized through the Jamaica Agreement. Fifth, we'll walk through the major shocks that have hit exchange rates since 1973, including oil crisis, financial crisis. Sixth, we'll study the long-running debate between fixed and floating exchange rates. Seventh, we'll look at the exchange rate regime that countries actually use today. Finally, we'll finish with a detailed country focused on China, since China exchange rate policy has been one of the most politically debated topics in the international trade for the past 2 decades. Keep this roadmap in mind as we move through the lecture together. Today, I'd like to start with the opening case of El Salvador. El Salvador is a country that made Bitcoin legal currency for the first time in the world, and then had to negotiate a bailout with the IMF. This case connects directly to several core ideas from this week's lecture, including foreign exchange reserves, the limits facing a dollarized economy, and the conditional lending power of the IMF. Let's look at what actually happened and why it matters for the international monetary system. El Salvador is what economists call a dollarized country. It has no currency of its own, and instead uses the US dollar as its official money. In 2021, President Nayib Bukele made a historic move, which was declaring Bitcoin legal currency, the first country in the world to do so. Here you can read the Forbes article here. And this is the president, Nayib Bukele. The stated goal was to regain a piece of monetary sovereignty that dollarization had taken away, and to reduce the heavy fees that Salvadorians paid when receiving remittances from relatives working abroad. In practice, however, Bitcoin's extreme price volatility and lack of transparency made the country's fiscal problem worse, not even better at all. Eventually, to avoid a full-blown financial crisis, El Salvador had to approach the International Monetary Fund for help. It was facing national bankruptcy. Seeking a rescue loan worth about $1.4 billion, structured as what the IMF calls an extended fund facility, or EFF. This set up a fascinating diplomatic standoff, which we'll explore next time. Notice how unusual this situation really is. A country without its own currency tried to leapfrog directly into a completely new, decentralized form of money, essentially skipping over the tradition path of first building an independent national currency. That gap between ambition and existing fiscal reality is exactly what eventually forced El Salvador back to the negotiation table with the IMF. This is where real business diplomacy enters the story. The IMF is the guardian of the existing multilateral financial order, and it pushes back hard against El Salvador's Bitcoin experiment. As a condition for its rescue loan, the IMF demanded that Bitcoin lose its status as a mandatory legal currency. No more legal currency. It also demanded that the public sector reduce its exposure to cryptocurrency risk, and that the government sell off Chavo, the state-run digital wallet it has built to support Bitcoin adoption. Why did the IMF push so hard on this one specific issue? It worries that if one country succeeded in making Bitcoin legal currency without consequences, this precedent could destabilize the dollar-centered, IMF-led global financial order that so many other countries rely on. President Bukele responded with what we might call a hedging diplomacy strategy. Publicly, his government appeared to compromise, softening the mandatory nature of Bitcoin's legal tender, legal currency status to satisfy the IMF, but secretly and privately, the government kept using national funds to buy more Bitcoin. They were borrowing the money from IMF with a promise not to use Bitcoin as an official currency, but they were secretly and quietly purchasing additional Bitcoin with the borrowed money, insisting that El Salvador would not stop its Bitcoin strategy no matter what outside pressure it faces. This kind of hedging diplomacy is actually quite common among smaller countries facing pressure from powerful international institutions. A government agrees just enough on paper to keep desperately needed funding flowing while quietly preserving its original policy goals wherever it still can. Let's pause here for a discussion question that captures the heart of this case. Is it legitimate for the IMF to restrict a sovereign country's own choice of a legal tender or legal currency simply as a condition attached to a bailout loans. In other words, is it ethically okay for a like IMF to intervene into the country's sovereignty? Like, the country made a big decision through the legal process, through the Congress. And IMF, because they lend the money, is it okay for them to intervene to the sovereignty of the country? That is a very important question. Or does this step over the line into the real infringement on national sovereignty? So there's no single correct answer here, and reasonable people disagree. What this case does show very clearly is the real limit that developing countries face under dollar hegemony. A country that has already given up its own currency, like El Salvador, has very little room left to experiment with monetary policy on its own terms, especially once it needs outside financial help. This case also shows how international financial institutions, such as IMF, use both soft power and hard power at the same time. Soft power comes through negotiation and persuasion. Hard power comes through loan conditionality. Real financial leverage that can force a government's hand when it desperately needs cash. Keep this tension in mind as we move to our lecture. Let's start with our first module. In 1944, representatives from 44 countries met at Bretton Woods in the United States. They created a new system of fixed exchange rate. This system had two goals that can pull against each other. One goal was discipline, keeping inflation under control. The other goal was flexibility, avoiding painful recessions. Let's see how the system tried to balance both goals at the same time. Okay, the first big idea behind Bretton Woods is the fixed rate regime imposes discipline in two separate ways. First, it puts a brake on competitive devaluations, which helps keep the whole world trading system stable. Second, and more importantly, for our example, it imposes monetary discipline inside each country. Think about Great Britain as an example from the textbook. Imagine Britain rapidly increases its money supply by printing many new pounds. This naturally leads to what happened? Price inflation inside Britain. Under a fixed exchange rate, that inflation makes British goods more expensive compared to foreign goods. At the same time, imports become cheaper and more attractive to British buyers. The result is a widening trade deficit. Since Britain starts importing more than it exports, to fix this imbalance under a fixed exchange rate system, Britain has only one real option. It must slow down the growth of its own money supply and bring inflation back under control. This is exactly why fixed exchange rates are described as a form of built-in economic discipline. A government simply cannot print money forever without eventually paying a real economic price. This is worth remembering whenever you hear a country described as running a large trade deficit under a fixed rate system. that deficit is often a visible symptom of a deeper problem back home. Usually excessive money creation or excessive government spending rather than an isolated trade issue on its own. Discipline alone was not enough for the designer of Bretton Woods. They also worried about flexibility. A perfectly rigid system of fixed exchange rates would probably break down, just as the earlier gold standard had broken down. Consider what happens if a country tries too hard to fix balance of payments deficit purely by slowing its money supply. This kind of strict discipline could force the country into a deep recession and create high unemployment. The architect of Bretton Woods specifically wanted to avoid this kind of outcome. So they built two important features of flexibility directly into the system. The first feature was a set of IMF, you know what it stands for, right? International Monetary Fund, lending facilities. The second feature was a system of adjustable currency parities. Let's look at each of these two features in detail on the next two slides. Notice the underlying design philosophy here. The founders of Bretton Woods were not trying to build a perfectly rigid system. They were trying to build a system disciplined enough to control inflation, but flexible enough to survive real economic shocks without causing Middle East unemployment. The first flexibility feature was IMF lending. The IMF stood ready to lend foreign currencies to member countries during short periods of balance of payments deficits. This mattered because a rapid tightening of a monetary or fiscal policy could seriously hurt domestic employment. To fund these loans, IMF members contributed a shared pool of gold and foreign currencies. A persistent deficit can slowly drain a country's own reserves of foreign currency, eventually forcing a currency devaluation. By providing short-term loans, the IMF essentially bought time for struggling countries. This allowed them to bring down inflation and reduce their deficit in a more gradual, less painful way. Countries could borrow a limited amount from IMF with very few conditions attached. But extensive borrowing was a different story. Heavy borrowers had to accept increasingly strict IMF supervision. This typically meant agreeing to IMF mandated target on domestic money supply growth, exchange rate policy, tax policy, and government spending. In other words, large loans came with real strings attached, similar to how a bank might require conditions before approving a large loan to a risky borrower. This structure still shapes how IMF operates today. Small, short-term assistance remains relatively easy to access, while large-scale bailout-style lending almost always comes bundled with a program of economic reforms that the borrowing government must agree to follow. The second flexibility feature was the system of adjustable parities. Under normal circumstances, exchange rates were fixed, but the system allowed a country to devalue its currency by more than 10% under special conditions. This required the IMF to agree that the country's balance of payments was in what was called fundamental disequilibrium. This term was never precisely defined in the IMF's own rule. In practice, it was meant to apply to countries facing a permanent negative shift in demand for their products, something that was not just a short-term or temporary problem. Without the option of devalue, such a country would likely suffer high unemployment and long-lasting trade deficit until domestic prices eventually fell far enough on their own to restore balance. Devaluation offered a faster, less painful alternative to that slow and difficult internal adjustment process. So together, IMF lending and adjustable parodies gave the rigid fixed rate system just enough flexibility to avoid becoming as brittle as the old gold standard had been. It's worth noting how deliberately vague the term fundamental disequilibrium was left. Our second module is about the World Bank, another institution created by Bretton Woods Conference. The World Bank's official name is the International Bank for Reconstruction and Development, or IBRD. Its mission has changed a great deal since 1944. Let's look at how it started and what it does today. Its official name is the International Bank for Reconstruction and Development, as I said. When the Bretton Woods delegates created the World Bank, their first priority was rebuilding the war-torn economies of Europe. The plan was to provide low-interest loans for reconstruction. In practice, however, the World Bank was overshadowed in this role by the Marshall Plan, under which the United States lent money directly to European nations to help them rebuild. So the World Bank shifted its focus and turned its attention toward development in poorer third world nations instead. In the 1950s, the bank concentrated heavily on public sector infrastructure projects. Power station, road building, and other transportation investments were especially popular during this period. During the 1960s, the bank broadened its focus even further. It began lending in support of agriculture, education, population control, and urban development. This evolution shows how the World Bank's mission adapted over time, moving from a narrow reconstruction focus toward a much broader development mandate across the entire developing world. The World Bank actually lends money under two different schemes, and it's useful to compare them side by side. Under the IBRD scheme, the bank raises money by spending bond in the international capital market. Borrowers then pay what the bank calls a market rate of interest, which is the bank's own cost of funds plus a small margin for expenses. This market rate is still lower than the rate commercial banks would charge. Under this scheme, the bank is willing to offer loans to risky customers with poor credit ratings, typically the governments of underdeveloped nations that could not easily borrow directly from private banks. The second scheme is overseen by the International Development Association, or IDA, which was created in 1960 as an arm of the World Bank. resources for IDA loans comes from subscriptions paid in the wealthy member countries such as US, Japan, Germany. IDA loans are reserved only for the very poorest countries in the world. Borrowers can take up to 50 years to repay at an interest rate of less than 1% a year. In the very poorest cases, countries may even receive grants or fully interest-free loans. Comparing these two schemes side by side helps make an important point clear. The World Bank is not a single, uniform lender. It actually runs two very different lending businesses under one roof. One funded through normal capital markets, and one funded through direct contributions from its wealthiest member governments. Our third module covers one of the most important stories in this chapter: the collapse of the Bretton Woods system. The system worked reasonably well until the late 1960s. Then it began to show serious strain, and it finally collapsed in 1973. To understand why, we need to understand the very special role that the US dollar played inside the whole system. The dollar was not only currency that could be converted into gold, and it served as the reference point for every other currency in the system. This means that any pressure on the dollar to the devalue could create serious problem for the entire structure. Most economists trace the breakup of the system back to US macroeconomic policy between 1965 and 1968. President Lyndon Johnson supported a large increase in government spending. This spending financed both the war in Vietnam and his domestic welfare programs. Critically, this spending increase was not paid for by raising taxes. Instead, it was financed by expanding the money supply. As a direct result, price inflation rose sharply, climbing from less than 4% in 1966 to almost 9% in 1968. At the same time, the higher government spending stimulated the broader economy. With more money in their pockets, American consumers spent more, especially on imported goods, and the US trade balance steadily began to deteriorate. This example is worth remembering well beyond this specific chapter. Whenever a government finances higher spending through the money supply rather than through taxes, inflation, and a weaker trade position tend to follow together almost as a package deal, not as two separate, unrelated problems. Rising inflation and worsening US trade position triggered heavy speculation in the foreign exchange market. Traders increasingly believed the dollar would soon be devalued. Matters came to head in the spring of 1971. US trade figures showed that for the first time since 1945, the US was importing more than it was exporting. This triggered massive speculative buying of German Deutsche marks. Deutsche mark is a German's currency. Since traders guessed the mark would be revalued upward against the dollar. On a single day, May 4th, 1971, Germany's central bank had to buy $1 billion just to hold the fixed dollar to Deutsche Mark exchange rate in place. The very next morning, the German bank, the German central bank, was forced to buy another $1 billion in just the first hour of trading alone. At that point, the Bundesbank, Germany's central bank, finally accepted the inevitable and allowed the Deutsche Mark to float freely against the dollar. This single event set off a much larger chain reaction across the whole international monetary system, which will follow on the next slide. Devaluating the dollar directly was not an easy technical matter. Under the Bretton Woods rules, any other country could simply change its own exchange rate by fixing a new rate against the dollar. But the dollar itself was the anchor currency of the whole system. It could only be devalued if every other country agreed to revalue their own currencies against it at the same time. And many countries did not want to do this since it would make their own exports more expensive relative to American products. To force the issue, President Richard Nixon took dramatic actions in 1971. He announced that the dollar was no longer convertible into gold. He also announced the new temporary 10% tax on all imports, which would remain in place until U.S. trading partners agreed to revalue their currencies. This pressure finally worked. It brought trading partners to the bargaining table, and in December 1971, an agreement was reached to devalue the dollar by about 8% against foreign currencies. The import tax was then removed. Unfortunately, this famous Nixon shock does not actually solve the underlying problem, as we'll see on the next slide. It is worth pausing on how unusual this moment really was. A single country unilaterally ended a promise it had made to the entire world that dollars could always be exchanged for gold. The promise had anchored the whole post-war monetary system, and its removal marked a genuine turning point in global economic history. Despite the December 1971 devaluation, the underlying problems never went away. The U.S. balance of payments position kept deteriorating throughout 1973, and the American money supply kept expanding at an inflation rate. Speculation continued to grow that the dollar was still overvalued and that a second devaluation would soon be necessary. Foreign exchange dealers began converting their dollars into Deutsche Marks and other currencies in anticipation. After a massive new wave of speculation in February 1973, matters reached a breaking point. On March 1973, European Central Bank spent $3.6 billion in a single day trying to prevent their own currencies from appreciating against the dollar. At that point, the foreign exchange market was simply closed. When it reopened on March 19th, the currencies of Japan and most European countries were floating freely against the dollar, although many developing countries continue to peg their currency to the dollar, and many still do today. At the time, this switch to floating rates was viewed as only a temporary emergency response, but it has now been more than 40 years since Bretton Woods collapsed, and that temporary solution looks permanent. The core lesson here is simple. The Bretton Woods system could only survive as long as the US kept low inflation and avoided a balance of payments deficit. Once both of those conditions broke down together, the system could not hold. Our fourth module covers floating exchange rate regime that followed the collapse of Bretton Woods. In January 1976, IMF members met in Jamaica and formally revised the IMF's own articles of agreement to reflect the new reality of floating exchange rates. This meeting produced several key changes that still shape the system today. First, floating exchange rates were officially declared acceptable, although members were still permitted to enter the foreign exchange market to smooth out what were called unwarranted speculative swings. Second, gold was abandoned as an official reserve asset. The IMF returned its gold reserve to member countries at the current market price and placed the proceeds into the trust fund designed to help poorer nations. Members were also allowed to sell their own gold reserves at market prices. Third, total annual IMF quotas, meaning the amount that member countries contribute to the fund, were increased significantly to $41 billion at the time. Since then, that number has grown enormously to $767 billion today, with the IMF membership expanding to 188 nations. Non-oil exporting developing countries were also given greater access to IMF funds under this new agreement. Together, these changes turned floating rates from an emergency measure into the accepted permanent foundation of the modern international monetary system. Our fifth module looks at the history of exchange rates since the 1973 collapse. Since March 1973, exchange rates have become far more volatile and less predictable than they were during the earlier Bretton Woods years. This volatility has been driven by a series of unexpected shocks to the world monetary system. In 1971, and again in 1979, OPEC dramatically raised the price of oil, first quadrupling it and later doubling it again, which badly hurt the US inflation rate and trade position. Between 1977 and 1978, confidence in the dollar fell sharply after a jump in US inflation. Between 1985 and 1987, the dollar fell rapidly against the Japanese yen and German Deutsche Mark. In 1992, the European monetary system partly collapsed under the speculative pressure. In 1997, the Asian currency crisis struck, and currencies in South Korea, Indonesia, Malaysia, and Thailand lost between 50 and 80% of their value against the dollar within just a few months. Finally, the global financial crisis of 2008 to 2010 was followed by European sovereign debt crisis in 2010 and 2011. Notice how this timeline connects with two different kinds of shocks: sudden oil price shifts and sudden financial crisis. Both types of shock repeatedly forced governments and markets to reassess currency values very quickly. Even under a floating system, the US dollar remains the central currency of the whole international monetary system. About 60% of global foreign exchange reserves are held in US dollars. About 90% of all foreign exchange transactions in the world involve the US dollar on one side of the trade. Roughly 40% of the world's total debt is issued in dollars. And the dollar is used in about 2/5 of all international payments. Why does the dollar enjoy this special position? There are three main reasons. First, the United States remains the largest economy in the world. Second, foreign investors have a strong faith in the US Federal Reserve's ability to control inflation and maintain the dollar's value over time. Third, dollar-denominated assets can be freely exchanged in an extremely large and liquid market, which makes the dollar convenient to hold and easy to trade almost anywhere in the world. Let's look at one of the most interesting periods in the whole chapter, the dollar's rise and fall during 1980s. Between 1980 and 1985, the dollar rose sharply in value, even though the United States were running a large and growing trade deficit. Conventional thinking would suggest a growing trade deficit should push the dollar's value down, not up. So why did the dollar rise instead? Strong US economic growth attracted heavy inflows of foreign capital, and high real interest rates attracted investors seeking strong returns on financial assets. At the same time, political turmoil elsewhere in the world made the United States look like a relatively safe place to invest. These capital inflows pushed the dollar's value upward. The dollar story does not end in the 1980s. In the late 1990s, the dollar appreciated once more, even though the US was still running a significant trade deficit, largely because foreign investors kept pouring money into US stocks and bonds, believing American financial assets offered strong returns. But by 2002, that fantasy began to fade. The US trade deficit hit a record of $791 billion in 2005, equal to 6.3% of GDP, the largest such deficit ever recorded as a share of the economy. Slower US growth, an expanding government budget deficit, and officials publicly talking down the value of the dollar all combined to weaken demand for dollars, which eventually slid to its lowest index value since 1973. In 2011, then surprisingly, from mid-2008 through early 2009, right in the middle of the severe US financial crisis, the dollar staged a moderate rally. Investors saw the dollar as a safe haven since conditions were even worse in many other countries at that time. Finally, between 2014 and early 2021, the dollar rose significantly once again, driven by the relative strength of the US economy recovery compared to other major developed nations. The lesson across both these slides is the same. Under a floating system, both market forces and direct government intervention can move a currency. sometimes in ways that seems to contradict simple predictions. Our sixth module tackles one of the longest running debates in the international economics: fixed exchange rates versus floating exchange rates. Even after the collapse of Bretton Woods, economists have never fully agreed on which system serves the world's economy better. Let's take a look. So let's begin with the case in favor of floating exchange rates. The first major argument is monetary policy autonomy. Under a fixed exchange rate system, a country's ability to expand or contract its own money supply is limited by the need to maintain its fixed parity. Monetary expansion tends to cause inflation, which puts downward pressure on a fixed rate, while monetary contraction requires high interest rates that put upward pressure on it. Advocates of floating rates argue that removing the obligation to maintain a fixed parity restores full monetary control to the government. If a government facing unemployment wants to expand its money supply to stimulate domestic demand, it can do so without worrying about depending on a fixed exchange rate. According to purchasing power parity theory, any resulting inflation should simply be offset by a matching depreciation of the country's currency on a foreign exchange market. In theory, this means that domestic inflation should not actually damage a country's internal cost competitiveness, since the currency depreciation offsets the rise in domestic costs. This same logic works in reverse too, allowing a government to contract its economy through monetary policy without needing to protect any fixed exchange rate parity. Floating rate advocates also point to two more benefits: automatic trade balance adjustment and help during economic crisis. Under a floating system, if a country runs a persistent trade deficit, the imbalance between the supply and demand for its currency in foreign exchange markets should cause that currency to depreciate. This depreciation then makes the country's exports cheaper and its imports more expensive, which helps correct the original trade deficit automatically without needing any international agreement or IMF approval. Floating rates can also help a country recover from a severe economic crisis. When a country is hit by a crisis, investors typically pull money out, selling the local currency and driving down its value. Eventually, the currency becomes so cheap that it starts to stimulate exports. This happened in Iceland, where the krona lost 50% of its value against the dollar and the euro after a banking crisis in 2008. By 2009, Iceland's exports of the fish and aluminum were booming, helping pull the economy out of a recession. A similar pattern occurred in South Korea after the 1997 Asian banking crisis, when the Korean won, fell from around 800 to 1700 per dollar, fueling an export-led recovery. Of course, there was a price to pay in both cases, since a falling currency also raised import prices and added to inflation. Now it's turned to the case in favor of fixed exchange rates. The first argument is monetary discipline, the same discipline we discussed earlier in the Bretton Woods example. Advocates of fixed rates argue that governments left to their own devices under a floating system too often give in to political pressure and expand their money supply too rapidly, creating unacceptably high inflation. A fixed exchange rate regime forces monetary discipline onto every member country, whether politicians want it or not. The second argument concerns destabilizing speculation. Critics of floating rates point to the dollar's rapid rise and fall during the 1980s as an example. They argue this movement had little to do with the competitive inflation rates or the actual U.S. trade deficit and everything to do with the speculative trading. When foreign exchange dealers see a currency starting to depreciate, they often sell it in expectation of further depreciation. As more traders jump on this bandwagon, their own expectations become self-fulfilling and the currency swings much further than its underlying fundamental would justify. Advocates of fixed exchange rates argue that fixed system would sharply limit this kind of destabilizing speculative behavior. Fixed rate advocates raise two more concerns: uncertainty and doubts about trade balance adjustment. On uncertainty, the unpredictability of floating exchange rates has made business planning generally difficult since the 1970s. It adds real risk to exporting, importing, and foreign investment decisions. Why would a firm change its export or investment plans after 6% fall in the dollar this month, if the dollar might simply rise 6% again next month? This uncertainty, according to the critics, dampens the overall growth of the international trade and investment. Advocates of floating rates do reply that forward currency markets can hedge against the risk. So they argue the true cost of uncertainty has been overstated. On trade balance adjustment, critics question just how closely exchange rates, trade balances, and economic growth are really connected. They argue that trade deficits are actually determined by the balance between a country's savings and its investment, not simply by the external value of its currency. They also argue that currency depreciation mostly just raises import prices and fuels inflation, wiping out any apparent gain in the cost of competitiveness. So who's actually right in this long-running debate between fixed and floating exchange rate? Honestly, economists still cannot fully agree. Business, as a major participant in the global trade and investment, has a large stake in how this debate gets resolved, since the answer shapes real world planning risk of every international company. The rigid Bretton Woods style fixed system probably will not work again. And speculation ultimately broke Bretton Woods. The very problem fixed rate advocates blame on floating systems. A different, more modern kind of fixed system might still prove more durable. Business has a large stake in this debate, since it shapes trade and investment risk. Let's look at how countries actually manage their exchange rates in practice today. Governments range from a pure free float, where market forces alone determine the exchange rate, to a pegged system that resembles important features of the old Bretton Woods approach. According to the IMF data, about 21% of IMF members allow their currency to float freely. Another 23% intervene only in a limited way. In what's called a managed float, a system practiced by China, among other nations, which we'll explore in detail shortly, about 5% of IMF members have no separate legal tender of their own at all. These are typically smaller states, often in Africa or Caribbean, that have adopted a foreign currency, usually the US dollar or the euro, as their own legal tender. The largest group, 43% of the IMF members uses fixed arrangement, pegging their currency to another currency, such as the dollar or the euro, or to the broader basket of currencies. The remaining share of countries use other systems, such as an adjustable peg that is allowed to fluctuate within a defined target zone. This distribution tells us something important. Even decades after Bretton Woods collapsed, a very large share of the world's countries still choose some form of fixed or managed exchange rate rather than a pure free float. Let's bring today's lecture together with our own takeaways. The Bretton Woods system combined monetary discipline with limited flexibility, using IMF lending facilities and adjustable currency parities to avoid becoming too rigid. The World Bank shifted its mission over time, moving from rebuilding post-war Europe toward long-term development lending for poorer nations. Bretton Woods ultimately collapsed once rising US inflation and a growing trade deficit triggered a speculation that the system could not withstand. The Jamaica Agreement in 1976 formally accepted floating exchange rates as the new standard for the global monetary system. Since 1973, a long series of oil shocks and financial crises have driven major, often unpredictable swings in exchange rates, with the US dollar remaining central to the whole system throughout. Both fixed and floating exchange rate regimes have real strength and real weaknesses, and economists still actively debate which approach serves the world economy better. In practice, most countries today choose some form of managed or fixed exchange rate rather than a pure free float. Finally, China's exchange rate history showed a more complicated picture than many people assume, involving both a period of deliberate undervaluation in the past and more recently, active government efforts to defend the yuan's value rather than weaken it further. Thank you for your attention for today, and I'll see you next week.